In this video, we'll consider Section 469, passive activity losses. This is another really interesting topic because, again, you get to see the interplay of the various tax rules and how they all fit into the big puzzle. Now, before we actually get into the passive activity loss limitation rules, we first have to have a loss from an activity. In a previous discussion, I mentioned how what a loss is very broad. It's broad in nature. It's not just the Section 1001 sale or other disposition, which that's what we normally think of when we think of a loss when you sell property and you have a loss as a result of selling something. It can also be a net loss from a business type activity or investment type activity. So for example, if you own a sole proprietorship and you receive $10,000 of income for the year, but you have $15,000 in allowable tax deductions that are related to the activity, that's going to be a $5,000 net loss. So that's what we're talking about. We're talking about a loss from activity. Now, going down the line with respect to the various limitations on losses, we next have to consider the general and specific loss limitations. So the general loss limitations, that's the big three. And before I go through the general and specific loss limitations and just a brief overview, remember that this is dealing with deductibility of losses. Can we actually deduct the loss on the tax return? So we're talking about deductibility concerns. So the general loss provisions deal with Section 165, and in Section 165, the big three types of activities with respect to losses. There's business, investment, and personal activities. Business and investment losses are generally allowed to be deducted, but the personal losses are not. That's the general rule. Specific loss limits deal with related party transactions, wash sales. There's others throughout the tax law, but those are some of the bigger ones. So once we have a loss, and once we go through the general and specific loss limits, and we're still good. We can still potentially take the loss. We then go through the Section 465 at-risk loss limitation rules, which there's a previous discussion on that topic that I really encourage you at this point, if you haven't looked at that, to stop and look at that video, because you do need to look at this in a certain order. Once you go through the Section 465 at-risk loss limitation rules, the next stop is that you then consider the Section 469 passive activity loss limits. So before I go through the specific rules of Section 469 passive activity loss limitations, I want you to consider Section 465 and 469 together, because prior to the 1986 tax code, there was lots of loopholes throughout the tax law that allowed for certain types of taxpayers that were in high income brackets, ordinary income brackets, as high as 70, 80, 90%, to lower their income using tax shelters. I know you hear the phrase tax shelters, like, oh, well, yeah, that's generally what Congress thought too. So they put in rules that kind of in play, these loss limits, to kind of stop a lot of the abuse. Now, in the at-risk loss limitation rules, if you watch that video, you will see what some of the abuse was with respect to non-recourse liabilities and how that was put at stop. Section 469 even goes further. So if you didn't get hit with 465 and you had this tax shelter, you probably got hit with Section 469. A lot of this dealt with limited partnerships, by the way, silent limited partner, but there's a physician or someone that had a lot of ordinary income in the high brackets, and they were trying to get themselves down to a lower bracket. So the passive activity loss limits really are the stop with the 465 and 469 to a lot of the tax shelters, but these rules still apply today. So with respect to passive activity loss, Section 469 specifies the rules for passive type activities and how losses are limited. But before we consider Section 469, it's important to understand the tax law breaks activities with respect to Section 469 into three activities. The first type of activity is considered active activity. Next, we have passive activity, that's the second. And third, we have portfolio activity. So active type activity is what you think of as active, where you are actually actively engaged in business, the sweat of the brow notion. You're not simply just investing and sitting back and reaping the rewards. If you are dealing with rental property, you're actually, out maybe doing maintenance on the property, cleaning the property, when you're showing the property, you're actively involved in, and also the management. You're also actively involved in the accounting and record keeping and managing and making it more profitable, those things. You're not simply just paying people to do that and you're just reaping the rewards with lots of capital. That's what we think of as passive. Passive is generally thought of as kind of like a silent partner in a limited partnership. And this, but by the way, this can apply to, not just partnerships. It can apply to, certain business activities or certain types of activities where you are as an individual owner. And finally, portfolio deals with investment type activity with stocks, bonds, that kind of thing, where you're not actively engaged. So I want to talk about the active activities. So in order to be active, you have to be what's called you have to materially participate in the activity. So for active activity, you have to materially participate. And this language is very important because this is in the regulations. And the regulations in section 469 really drive the rules here. Now, a taxpayer materially participates in an activity if he or she is involved in the operations of the activity and these are really important. There's three things. There's three things to really key in on. So the things that are important to whether a taxpayer is materially participating in an activity, the taxpayer has to have regular, continuous, and substantial basis in the activity. Regular, continuous, and substantial basis with respect to the actual activity. And that's what makes it the person materially participate in the actual activity. If you do not materially participate and you are not involved in portfolio type income, you are going to default to the passive activity rules. You're going to default to the passive activity rules. Now, why does it make a difference? You might ask, why? Why does it make a difference? Well, of all three of these, passive are the most limited. Passive activities are the most limited in terms of losses. Most limited. So you might see this theme with respect to, we've seen this elsewhere. When we talked about general loss limits with respect to section 165, remember the big three activities, business, investment, and personal. You always wanted to get, if you can, business. If you don't get business, get investment. If you can't get investment, get loss. Get loss. Get personal. And the reason is because personal type activities under the big three for general losses are the most limited. The same applies here. Active is going to be the least limited. Portfolio is going to be next. And then passive is the one that has the really strict rules with whether you can actually take a loss or not. So the general idea here is if you have active income, you can offset your active losses with your active income. So it's within the basket. So we call this a basket. So think of this like a basket. If you have income that's considered, you materially participate, that's considered active income. Let's say you have two businesses. Then that's how you make your money to live off of. In one business, let's say that you have a commercial fish operation and you are actively involved because you're actually going fishing on a day-to-day basis. A second business, you own rental properties, but you pay a management company to deal with all of the day-to-day operations as well as, getting tenants, collecting the money, all that stuff. That's going to be passive because you're not considered materially participating in the activity. If you have active income from your active activity from the fishing operation, but you have losses from the rental property because let's say you don't have a good year, maybe the rent is going down because the property values are going down and whatnot, you have a bad year, well, you can't offset. You can't take the loss here and take it against active income. You can't do that. That's not allowed. You're not allowed to do that. You can only do it within the basket. You can only do it within that basket. You can only offset a loss with income in the same basket. And that applies to all the baskets, generally speaking. Now, how do we know whether someone materially participates? And there is multiple factors involved here. It's not a bright line rule. In the regulations, in section 469, the Treasury Department has listed 7 situations where a taxpayer will be deemed to materially participate in activity. And I'm just giving you an idea. There's other ways. So the best way to think about this is it's kind of like a safe harbor. If you meet one of these, then you are considered materially participating in the activity. But if you don't, you can still argue that you materially participate. That's really important to understand. So if you meet it, a safe harbor, so under the regs, there's a safe harbor. And this is, if you are unfamiliar with safe harbors, safe harbor, if you meet one of the rules in the safe harbors, then you are whatever that rule is, the material participation. But if you don't meet it, you still might be able to get the material participation by arguing, hey, look, I don't meet any of these criteria, but you can argue based on facts and circumstances, hey, I am an active participant. I materially participate in my activity for these reasons. Because the idea is that, Treasury can't think of all the different situations. And these are very bright line rules. So I just want to mention a few of them. Again, there's 7 mentioned in the regulations. So the first one is that there's participation in the activity for more than 500 hours in the taxable year. Another one deals with 100 hours in the taxable year, provided the taxpayer's participation equals or exceeds the hours of participation by anyone else in that activity. So if you're you do the most work of anyone in your business, and you do 100 or more hours, then you're materially participating. So there's like hour tests. Again, you don't have to go under these safe harbors, but you can meet it based on the safe harbors, which are mostly hour tests. So let's say we've determined that you are passive. You have passive activity. So if your losses exceed your income from that with respect to that year, then you are most likely going to be limited. Now, there's special rules. There's special rules that apply to certain industries, like the real estate industry. Real estate passive activities, you're allowed to offset a certain amount of income. And this is something that you should look up because it does change. At one time, it was $25,000. You can offset $25,000 of passive losses if you're real estate against active income. There's special rules for certain. By the way, the way it comes out is through lobbying and whatnot, just so you know. So if you meet those special rules like the $25,000, you continue to the other loss limits, which are going to be the capital loss limits, and there's a few other ones. And then finally, you can probably deduct it on your tax return if you go through all that. But if you don't have the special rules, then the loss is suspended. It's suspended until you have income in the future within that same basket. Now, if you are active or portfolio and you have a loss that exceeds the income within that basket, it most likely can go on the tax return. Now, you have to consider the other loss limits. So, for example, the portfolio, if it's considered capital, which most likely it would be, you probably are going to be limited to what you can take that year, subject to other loss limitations. But the passive, that's what the rules are. Yes, we have 3 different baskets, but the Section 469 deals with the passive. It deals with the passive. That's what it's really getting at. So that's really what this is all about, is Section 469 is putting severe limitations on the passive type activity. And I'm sure you can think about different types of activities out there that are passive. The idea is that the passive activities, like, if you're a silent partner, you're not really doing much of the work, you're paying someone to do the work, or you're not really involved, you're considered passive in that nature. If you have losses, you can't offset your income, which could get you down to a lower bracket, which is what the tax shelters are all about. Now, one thing I want to say is that if you do have passive losses and you keep offsetting them, you keep carrying them forward. So the suspended means you carry them forward. They're suspended until the future, until you have the passive income. If you keep carrying forward and you never have passive income, once you dispose of the activity, you then can take the losses against active income or other income. Now, what if you have passive losses that do not exceed the income, they're equal to or do not exceed, then you can take them. You can take them because your income, it's the same or it's more than, so you can take it. It's going to offset that. So you're going to show a net amount on your tax return that is positive, so it's taxable. So you can offset it. This is kind of similar to the hobby loss rules. You might recall that where you can only take, if you're a hobby loss, if you're a personal activity and hobby loss, you can only take the the amount of the loss or deductions to the extent of income. But the thing is that this is suspended, so it's a benefit in that it allows you to actually look forward when you do have income. Because some activities, maybe early on, you don't have any income, but you might in the future. So this really is different with respect to hobby losses. So contrast that with hobby losses, right? Versus hobby losses. This is not the same because of the suspension. That's different. With a hobby loss, if you don't get a certain loss or deduction as of a year, it doesn't get transferred to the future. It's just you don't get to take it. It's not allowed. All right. So that really concludes the passive activity loss. One thing I want to mention before I end this video is, again, if you do meet the criteria that you can take the loss under active, passive, or portfolio within your basket, within the various activities you have, then you have to consider the other loss limitations, because there are other ones, capital loss limitations, maybe some other ones that are out there. And then finally, after you go through the rest of the loss limitations, then you can finally put it on your tax return, which results in actually getting a benefit.